Good morning and welcome to our quarterly meeting, Income Tax and Estate Law Updates. I want to mention a few chapter events coming up. We've got a webinar series, State of Probate in Georgia, How the Pandemic Changed Things, on February 5th from 12 to 1. Also a webinar series, The Referral Generating Machine, on March 5th from 4 to 5. And last but not least, our annual regional symposium on May 1st from 8 to 5. We've got discounted early bird registration available now. Please check our website for updates, details, and register today. We are thrilled to be joined today by Cas Pittman, partner, Smith+Howard Advisory, LLC. Cas joined Smith+Howard in 2008 and is a partner in our tax practice. Prior to joining the firm, she served as a tax manager at one of the largest locally owned accounting firms in Northeast Florida. Her public accounting experience includes compliance and consulting services for a wide variety of clients, including partnerships, LLCs, C Corps, S Corps, captives, estates, trusts, and individual tax returns. Also joining Cas is Andrew Hedrick, Senior Manager, Tax Practice, Smith+Howard Advisory, LLC. Andrew joined Smith+Howard in 2014 as an intern and is a Senior Manager in the tax practice. Andrew's main focus is with the firm's professional service and nonprofit groups, specializing in law firms and private schools. Beyond his specializations, his work also with corporations, multi-state partnerships, and high net worth individuals, all in an effort to provide comprehensive, value-added consulting to his clients' immediate and future needs. And with that, I'll turn it over to Cas to begin.
Great. Thank you so much, Kathy. Thank you to Eileen and the whole group for having us. We're excited to be joining you this morning. Sorry it's not in person, but hopefully everyone is going to get to enjoy a little bit of the white snow today. We definitely have it here on our end. Thank you for the introduction. That really covers. Andrew and I, we work a lot with our clients with planning, not only for, tax reduction, but also structure and using of, trusts and different entities. So we look forward to joining you this morning to talk on some of those topics. As you know, 2025 is really a pivotal year for tax planning with key laws about to expire or set to expire. So we wanted to frame our presentation around those changes and around strategies that be impacting our individuals as clients, the families and individuals. We're going to walk through some of the legislative updates that we have, the expiring laws that we know are currently set, and then strategies consider as you look through this year. One thing to note, Andrew and I don't have anyone moderating the Q&A, but if you have questions during the presentation, please go ahead and post them. And if we don't answer them if we have time afterwards, we will. And otherwise, we'll address those. We can address those through email later. Andrew?
Yeah, so thank you for that, Cas. I would echo Kathy's opening that. I mean, that's a better presentation in terms of what Cas and I do than I've been able to summarize over the past. However, as you cozy up with the snow and what looks like a Robert Frost poem outside, what better topic to discuss than taxes in regards to both upcoming incoming administration as well as just current tax laws ending in the next so on and so forth by 2026. So we're going to start our presentation with some legislative updates, and then we're going to go into actual planning based on what we know. By all means, feel free to add comments at the bottom, and we'll try to provide stories as well to help drive our points home for you. So with that being said, we're going to jump straight into the legislative updates and speak mostly to what incoming administration has done in the past and what they plan to do going forward. First things first is, in order to have a proper framework for this discussion, we have to keep in mind the various things that got us to this point, which is what happened last administration when President Trump was in office. Within his first full year, he had passed the Tax Cuts and Jobs Act. And with that passing, he was able to essentially a litany of business tax deductions and cuts to various different sectors of the economy and the corporation world. Part of that was to reduce the corporate tax rate from 35 down to 21%, which was a largest tax cut on that front and quite a bit. And in addition to that, there were other alternative ways to help bridge the gap for some individuals. That included creating more tax brackets, as well as cutting the highest individual tax bracket from 39.6% down to 37%. Now, the thing to keep in mind with these rules is that some of them were permanent, such as the corporations ones that we see on the screen, whereas others were also more of a temporary 10-year program, which was a lot of the individual items. That timer is running up on 12/31/2025. So based on current laws and sunsets, we have some discussions to be had in the coming year about, okay, how do we properly plan with what we know is current law? But also, how do we potentially take into account the fact that President Trump and Vice President Vance is taking office in a couple weeks as well? What does that look like in terms of the tax landscape, and how do we properly plan for that? Oftentimes, you'll hear on the campaign trail a few things that come to mind, but in particular, there's going to be a lot of focus on individual incentives to help bring them in line with how the corporate taxes were favorably impacted back in 2017. With that being said, let's take a look at the actual campaign proposals, which is mostly centered around extending certain provisions of the prior bill. Overall, we know that there were ways to pay for the tax cuts based on the 2017 bill. And generally speaking, the way to pay for those tax cuts for the corporate side was to limit some of the deductions on the individual side that we'll talk about later. So the question would be, can we bring back those deductions in a way that
Uh-oh, I think we might have lost Andrew there. Kathy, do you have the slides by chance?
Yes, I do. I'll have to pull them up. 1 second. Uh-oh.
Here, I can probably share as well.
Second, I do have them up. If you'll just let me know when to advance.
Okay, sure thing.
Or tell me where to start here.
Let's see. We were at, see what slide number. You continue on. It is. This would be great. So what Andrew was discussing is a lot of the things that we look at when we're thinking about planning this year. You know, we don't have the known changes yet because that is going to take those tax changes to be set in law, like we saw back in 2018. But some of the things we did see while they were on the campaign trail, and we've heard discussions on, and we know from the past administration, we can look at and start thinking about and think about where we have options there. And so some of the things that were being discussed were decreasing taxes. And so we don't expect taxes to necessarily increase for our individuals and corporations, and we see those coming down. There were talks on the campaign trail of reducing the corporate income tax rate from the 21% that it is currently, the flat 21%, down to a 15 or 20%. Exempting wages for hospitality workers from tax, as well as changing Social Security benefits and overtime. So we're seeing a lot of changes that would decrease that tax base. And so in order to do that, we have to have a funding side. And so possible funding sides that we saw and heard about were the increase of tariffs, which I know that's we've been hearing a lot on, and that definitely will affect our businesses and trade and costs there. And so there's also the talk of repealing the most recent act, the Inflation Reduction Act, which had a lot of green energy credits in that. So pulling that back to help increase that base. Taxing nonprofits has been thrown around on different characters of their income that aren't currently taxed. And then there's a few other, items that are out there, and there's going to be more that come up. So it's going to be a matter of watching and seeing where this goes. But for right now, we just wanted to bring up that these were the items that we saw most often discussed on the campaign trail. I guess, Kathy, if you'll move it forwards for me. So looking at what we do know, as it stands right now, if nothing is agreed upon, there's no extension by Congress, or if we aren't able to extend it under reconciliation procedures, right now, there are several laws that will be sunsetting after 2025. So we'd like to bring this up and just to kind of set a reminder of where these might be affecting individuals, because that's where we've been looking at making sure that things are in place. So the items that are sunsetting, especially affecting individuals and small businesses, will be your AMT exemption. A lot of people have forgotten what the AMT regime is because we haven't had miscellaneous itemized deductions. And we've had a very large AMT exemption. So if the AMT exemption phases out, as it's set to do, right now it's at 1.2 million, so it's not affecting a lot of taxpayers. It's going to go back down to about 200,000. And so you'll see a lot of people being captured under the AMT tax again. As I mentioned, miscellaneous itemized deductions. So the standard deduction would be about roughly half of what it is right now. Right now, married filing jointly is about 30,000. That's going to reduce down. And with the standard deduction reducing down, it'll mean that more people will be able to do itemized deductions. So the changes involved with that right now would be that the itemized deductions would allow miscellaneous expenses, which those expenses that were eliminated in 2018 included investment fees, accounting fees, employee unreimbursed expenses. So all of those were no longer deductible. Those would come back and be deductible. But of course, on the AMT side, those would not be deductible. So you'll see that play between regular tax and AMT tax come back in. State and local taxes, right now, state and local taxes are limited to $10,000 in aggregate. So that's your real estate taxes and your state income taxes. Right now, after 2025, there would no longer be the cap of $10,000, and those could be fully claimed as an itemized deduction. Bonus depreciation, which currently is reducing down for 2025. It's 40% of a new addition that qualifies for bonus depreciation can be accelerated into the current year. After 2025, that would be down to 0 if nothing's done to bring back that bonus depreciation. A large one for business owners is the qualified business income deduction would go away. And this is the 20% deduction right now that's available for qualified income passing through to owners on their individual 1040s. And then the estate tax exemption amounts would go back to the pre-Tax Cuts and Job Act. I know we've heard a lot about this, and there's a lot of planning around this. And so that would be taking, the 13.9 million lifetime exemption back down to probably around a $7 million without any change. And Kathy, can you move forwards for me? Thank you. And we just wanted to touch on briefly, I know beneficial ownership information, and we can scroll on to the next screen. We have a few details on that. Has been in the news a lot and has been very well publicized. There was a lot of bouncing around the holiday time, so we just wanted to touch base on this. As just a reminder, the new reporting requirement is with FinCEN, which is our Financial Crimes Enforcement Network. And it was requiring that certain persons disclose an owning or controlling interest in entities, as long as those entities weren't exempted by the filing. And if they weren't exempted by the filing, and the exemption pretty much eliminated where large operating companies would have to file. This was really capturing your small to medium sized operating or businesses and operating trusts. So think about if you had LLCs holding real estate. This would pull them in order to have this disclosure requirement. So the requirement was that it had to be filed no later than December 31st of 2024, which is obviously already passed. And if it wasn't filed, there were pretty significant daily penalties. So before the deadline, it got pushed back because of a case coming out in Texas, looking at whether this should be legal. And so it went back to being required by January 13th, and it has now bounced back. That has actually been set aside and vacated until March. So this has now been pulled back. The filing requirement is not currently required until this can be looked at in March. We are telling people to be ready for it, to be watching for it. I know our firm sends out web blast. Really make sure if you haven't filed and you're waiting to see if you have to file, that you're conscious of it and have it on your reminders in March to see where the status is of it. Something to think about for Georgia residents. If you're in Georgia, South Carolina, North Carolina, you're going to fall under the Hurricane Helene disaster relief as well. So similar to your income tax returns and fourth quarter payments and any filings due before May 1st, you would have that extension for this filing as well until May 1st. But we are recommending that you keep it in mind. And once again, we'll see come March if this is going to be required. And Kathy, move forward. Great. So as we're looking forwards to 2025 and the current rates that we do know are in place, we have a little bit more clarity that, where we expect taxes to be for the next 4 years. And so we're in the normal planning mode of reducing income, reducing taxes for most taxpayers. And so we just wanted to touch on kind of the individual tax planning behind that, and also wanted to touch on kind of how the different tax buckets work, different income buckets work. And so for ordinary income, we just wanted to touch on what the current brackets are and how it works. Since sometimes there's a misconception that it's a flat rate for individuals versus a graduated rate. So these are the current year buckets. So you can see we have single filers, married filing, joint, head of household. And each dollar of income works through each bracket. So if you look at somebody or a couple, say married filing jointly, that makes $400,000 a year, they're in the they'd be referred to as being in the 32% tax rate, but not all their income would be at the 32% rate. Actually, only a small amount would be. And so when you run how their taxes would end up, they'd have taxes around $82,000. So they're really paying about 20% on their total income, but every next dollar of income would be taxed at 32%. So when we're looking at planning, really looking at where those brackets are to make sure that we're considering if income should be pushed into a future year or kept in the current year is important. And Andrew, are you able to?
Yes, can you hear me?
I can hear you.
Okay, sorry about that. I don't know when I canceled out and I realized too late probably, but yeah, I can jump in here and kind of help speak to the next points, which is the long-term capital gains side of things, as well as just other planning opportunities within that space. So big picture, a common thing that you'll hear, especially when you're talking to your advisors or to your buddies, if you are, about taxes, is how do I get into the 20% bracket? Because that's the ideal tax preferred bracket. But it's only really available to what we classify as long-term capital gains, which pertain specifically to investments that you're owning and either realizing from the investment of it, so selling said investments, whether it be stock, property, or business assets to some extent, you can qualify for a more preferential rate at 20% based on the various thresholds you see on your screen here. Big picture, there are planning opportunities to utilize within this 20% bracket, but it's not the end all be all. I would say to keep it in mind, there are certain things that you want to be thinking about from a charitable donation standpoint, where if you're looking at your sources of income for the year for you or for your clients, and you're realizing that the vast majority of your income is going to be taxed at 20%, then perhaps it may not make sense to donate to a charity this year, which would be a bit more of a better benefit if you were to do that in a year where you're going to be taxed at a higher tax rate, right? So it's also keeping in mind not just the fact that you have income, but what's the character of the income that you have going into your year-end planning to determine some of the courses of action you want to take to help bring down your tax or pay the lowest tax possible for your situation. And thinking about that, going to the next slide, we have various deferral strategies that we can think about from a capital gains perspective. One thing that we commonly think about, I mean, on this screen, it says, rebalancing your portfolio to offset gains with losses. A common phrase that you'll hear is harvesting losses. And what we would highly recommend is that that's something that happens throughout the year, where you constantly are working with your advisor, your clients are working with their advisors to rebalance their portfolio so that it's a bit more taking advantage of products that may be a bit overinflated and finding opportunities to maybe rebalance it, recognize some gains, or harvest some losses in areas that are loss leaders to help bring your net impact for the year from a tax perspective back closer to zero from a income net gain. But it also helps you rebalance your portfolio into various trends that are rising in the market that you want to be on the early end of, as opposed to catching up on.
And something also with that, sorry, I'm going to over talk you. But also, if at year end, if that's the only time you're looking at harvesting losses, if we're having a good year, and like we saw this year with the market going up, there actually may not be as many opportunities there to help rebalance. So just keeping that in mind throughout the year.
Very good point.
And I guess our second note here is also considering the charitable donations of appreciated stock. And that is a tremendous way to help with your gains. And if you have an individual with a lot of appreciated stock in their portfolio, by being able to transfer that to a donor advised fund or directly to a public charity, it allows them to completely eliminate the gains on that appreciated stock and take the fair market value of that stock as a charitable donation. So if you're looking at the total benefit of that, if you have somebody that has appreciated stock that says has a gain of 100,000, if they donate that stock, they're eliminating picking up that gain of 100,000, which would at 20% with the 3.8% investment tax on top, that would have been 23.8 or 23,800 of tax they would have paid on those gains. And then they're also getting the charitable deduction to reduce their income. So, at a 35% bracket, by donating 100,000, they're saving 35,000 in taxes right off the top. So that is definitely a strategy that we see with clients that is very, very impactful. There's also qualified holding qualified small business stock, and that's going to relate more to individuals holding C Corp stock. And there's certain qualifications that go with that, but if a company meets those qualifications, the gain on that sale could be excluded as well. And then just something to keep in mind as people are, downsizing and moving homes. If they've lived in their home for 2 of the past 5 years as a principal residence, a couple can exclude up to 500,000 of that gain with the sale of that property. So that definitely gives some flexibility for people.
Excellent. So that's basically a lot of the planning tips you can do from an income perspective. But as you're well aware, a lot of the things that we talk about and what you hear about in my realm from just various colleagues as well as people who trust me now with tax advice is how do I get more deductions, right? And what's the availability from an individual to claim tax deductions when they're filing their returns. So we wanted to focus in here a little bit on various different strategies to keep in mind from an individual perspective that most, if not all, homeowning or other types of individuals can think about. But the first thing here to consider is just standard deductions, which is on this screen, which is essentially what the IRS provides you as an automatic reduction of your taxable income for standard cost of living expenses that you incur throughout the year. If I were to make $100,000 between me and my wife, technically I would get a $30,000 quote unquote deduction, so that I'd really only be taxed on about $70,000 of my total income for the year from a tax perspective. That's the common actual methodology that most taxpayers use as the standard deduction, especially since the Tax Cuts and Jobs Act's passing of 2017, because what it did was it essentially doubled the benefit of the standard deduction, because in the past it had been closer to $10,000 to $12,000 per year per married filing joint individual. And as you can see here, we're well double that since 2017. But the thing to keep in mind here about some of the sunsets that Cas mentioned earlier is that a lot of these may revert back starting on 1/1/2026 to $14,000, which if you're not thinking about that and careful, that's $16,000 of additional income that'll be taxed that hopefully your employer's W-2 withholdings will take that into account. But it's something that you may not be taking into account, especially if you're in that 20-25% bucket and you have now 16,000 more of taxes to pay. I mean, that equates to about 4,000 more on your tax bill next year, just from no change year over year. So with that being said, that's when you need to consider, are there any other alternative things to be capturing with my taxes that'll potentially push my deductions over the standard, which is what we refer to as itemized deductions. So going to the next slide, Kathy, we have the start of our list of various itemized deductions that we can take into account for the year. But I'm going to spend time mostly on 3 of them. One is state taxes. The second is charitable giving. And then the third is just interest expenses that you can properly claim. But the first one to take close attention to is your state taxes. And when I say state taxes, what I'm talking about in particular are income taxes that you owe on your earnings. So and for us, it's in Georgia. So any income taxes paid to the state of Georgia, as well as property taxes paid on your primary or secondary homes. Other types of tax currently are not necessarily included. So like sales tax that you pay on all your goods, that wouldn't be taken into account here. That's not necessarily what we refer to as a state tax to claim for itemized tax purposes. But generally speaking, we're referring to your withholdings on your Georgia income as well as your property taxes. And why this is important and why most individuals that are higher net earners are becoming more standard deduction claimers is because as a way to pay for the tax cuts back in 2017, they basically capped the amount that you could claim of a state tax to $10,000 for the year, which is a big reduction compared to what it used to be able to claim. I mean, if you think about your personal property taxes, I mean, I'm looking at my house and it's, $7,000 of real estate taxes each year. But in Fulton County, I know there are plenty that are 20,000 plus, and that's not even taking into account your individual income taxes from Georgia, right? So you could be spending upwards of $50,000 personally towards these various tax tranches, and you can only deduct $10,000 of it. So that is something that has helped pay for a lot of the tax cuts over the past 10 years, is this artificial cap on these taxes that you can claim as a deduction. But it is something that, based on current law, will come back into fruition starting in 2026, where you're going to be able to deduct the amount that you pay as opposed to just capped out at $10,000. Now, that may have some negative impacts from what we would refer to as an alternative minimum tax perspective on your individual side of things. But for the most part, people are looking forward to the ability to, deduct their taxes again, even if it comes with a little bit of a bite from an alternative minimum tax perspective. The next slide I want to talk about in particular is charity, and what we can do from a charitable donation perspective when claiming itemized deductions, or even thinking about it from the next phase in your career post working, is thinking about it from a retirement perspective. You can, donate to your church, to a local nonprofit that you like, or what have you, to do non-cash goods to a Goodwill, right? And in many cases, you can claim that as a charitable deduction on your itemized deductions. So keep track of those payments throughout the year so that when you go to your return, you have an easier way to trace how much you've given during the year. But as I mentioned, it still may not be enough to get you past the standard deduction. And if that's the case, it may not be the best use of your goods to go ahead and donate them this year if you're not going to get the benefit for them, right? So we have to think about this from two perspectives. And what I want to think about real quick is from a retirement perspective. If you're retired and you have sources of income associated with your pension, your retirement account, and Social Security, and that's it, it's likely that you're not itemizing your deductions, right? So is there even a point to donating to charity? And this is where there are different alternatives where you can think about providing a different mechanism to still get qualified charitable deductions on your return, but not doing it from an itemized deduction perspective. And what that's referred to is the qualified charitable distribution under an IRA. And when you have your IRA, what you have is what we call a required minimum distribution when you hit a certain age. But you may not need that as a retired individual. You may have the funds set aside. So if I'm supposed to get $30,000 of a required minimum distribution from my retirement account this year per the rules of the plan, well, I don't need that. So can I just give it away to charity instead? And the answer is yes, you can. And in many cases, you can do both, giving away to charity while also taking advantage of the higher standard deduction. And the reason why is if you do a qualified charitable distribution from an IRA directly to a 501c3 nonprofit, it is treated as a reduction of your retirement income directly, as opposed to an itemized deduction. So in the previous example, I would be a standard deduction filer given up to $30,000 of an automatic deduction from the IRS. If I do this QCD approach, I can get basically an exemption of income recognition from my retirement account. So that's a $30,000 net benefit. Plus, I can parlay onto that the $30,000 standard deduction, because this QCD goes around or circumvents the use of itemized deductions. So instead of only getting a $30,000 deduction, I would get a net $60,000 tax benefit and reduction of income as a result of that approach.
And where we see clients using it right now, or I have some clients that use it, as where they don't have mortgage interest, their homes are paid off. So really the only thing that's going to push them over $30,000 to be able to itemize would be charity. They're able to use this and still use the standard deduction of $30,000 and reduce their income. And something to keep in mind, it's reducing your income. And so there's other pieces of a tax return that look at adjusted gross income to determine if there's additional tax, one being net investment tax. And so if you can pull gross income underneath that level, then the 3.8% investment tax isn't going to affect the rest of your investment income. So being able to use the QCD may be very beneficial for a client.
Yeah, thank you, Cass. A couple other quick items on charitable contributions on the next slide that we can just high level speak to. I know Cass already mentioned the donating appreciated securities to a donor advised fund or even a private foundation to some extent as a good planning mechanism, and definitely something I would reiterate here. But also going back to my point earlier, where if you look at all your deductions for the year and you realize that, hey, it may not make the most sense to do my charitable giving this year because I'm not going to get the immediate benefit for it, what you could do is do a clumping or a lumping strategy where, hey, maybe instead of donating evenly over 2 to 3 years, maybe I just batch everything together into 1 year to ensure that I get the best benefit for those charitable dollars that I give away. It's still in total going to the causes I appreciate, as well as, you know, the amount that I plan to give. It's just all centralized within one tax year, perhaps a year in which you know you're going to have a lot of income, to help bring down your tax burden to some extent. And that way you can actually get the benefit of the tax deduction in addition to the benefit of, you know, the social good you're doing to the community. The final thing that I want to talk about from an itemized deduction standpoint real quick is just interest expenses that you can claim, which is on the next slide. The common here to think about is your mortgage interest, which for the most part, if your loan is less than or equal to $750,000 of indebtedness, you should be entitled to a full deduction of your mortgage interest that you pay throughout the year. But there's also other types of interest that you could potentially claim, which one of them is what we refer to as a margin loan on your investment. So if you take out credit on your investment account to purchase securities, you're going to incur interest expense against that loan. So one thing that you can consider there is that interest expense is able to be claimed as a tax deduction only to the extent that you have earned investment income, to be quite clear. So generally speaking, they already put caps on how much you can take as a loan from these portfolios. I talked with my advisor over the past year just in regards to home projects, and he said I can only take about 50% of my outstanding investment balance as the max amount. So there's some leverage in there just to prevent there from being abused from just taking out a loan just for the sake of getting investment interest. But it's also something to consider if you're looking to diversify your portfolio or you have taken out a credit. You might have some what we call margin loan interest that you can claim as a tax deduction. With that being said, that kind of takes us to thinking about future tax planning. So I'm going to pass it off to Cass here, who's going to talk real quick about a couple items in relation to retirement planning as well as IRAs in particular.
Great, thank you, Andrew. So looking at retirement income and where those limits have changed, for 2025, the 401k contribution limits for employees increased and the catch-up increased as well. 401ks and Roth 401ks are definitely a great vehicle for individuals that are still working. The 401k will defer that income and bring down their taxable income for the current year. And of course, the Roth 401k, which is newer product, we'll put it similar to a Roth IRA account where it would be taxable now, but when it's pulled out later, would not be taxable. We had some other changes that came through in our tax changes coming through for this year. And so starting in 2026, there are some limitations on catch-up contributions and making sure prior year income was hitting a certain level. Roth IRAs, generally, there's an income threshold that you have to look at to make sure you can contribute in, unless you go about it in other other methods. And then looking at, especially for our business owners, what we find very useful as a retirement plan option and tax deferral strategy option is using a SEP IRA. The limit for that is $70,000 for 2025. It's eligible for up to 25% of employee comp. Generally, with a self-employed individual, when you factor in the math for self-employment tax, it's really, you can think about 20% of your self-employment income that's flowing through as kind of the formula. But they can set aside up to 70,000. And the big thing with this product is that it is one of the only deductions that a cash basis taxpayer can take with taking and actually moving the cash in the year after. So with a SEP IRA, your individual business owners can wait until they see where income has turned out. And as long as they fund the IRA by the time they file their tax return, so whether that's April, September, October, or the following year, as long as they fund that SEP IRA before filing, they can use that deduction on that tax return. So that's a difference that we see from a lot of other deductions that we can take that generally have to be done before 12/31. And then if we can jump forwards, we just wanted to note with the Secure Act, there were some kind of some leeway given with withdrawals on retirement plans. Generally, there's a penalty for pulling money out if you are under the age requirement. With the Secure Act, there was some leeway given. You could pull out $5,000 for adoption or birth expenses. And so those would still be taxable as ordinary income if it was, say, from a 401k where it's been tax deferred. But they would not have the penalty on top with that. And then we also saw the required minimum age change. And so this got a little confusing, but depending on when you were born, changed the year in which you needed to start your required minimum distributions. And so we just wanted to note this to make sure it's in everyone's mind, because missing those required minimum distributions can make a huge difference for a taxpayer, being that there's a pretty large excise tax that will come into play if distributions are missed. Generally, you can get them waived, but keep this in mind. And it also helps with planning so that individuals know they are going to have a jump in their income, or if they need to withhold on it, they can. But just wanted to point out these dates are moving back. And then the inherited IRA rules, just noting with your spousal beneficiaries, they have the option to roll it into their own set aside for themselves on their own IRA as an inherited IRA, or to use the 10-year rule where it's going to be distributed out within 10 years. And that's the same rule that applies for your non-spousal beneficiaries as well.
So going over now into other retirement accounts, I want to pause here and speak to a common question I get, not just from my clients, but also now more increasingly from my family who is entering retirement age, which is Roth accounts and Roth IRAs in general. The buzzword over the past 5 or 10 years or so has been this Roth program, because what it essentially does is it allows you to contribute post-tax dollars now into a retirement account, whether it be a 401 or an IRA. It can appreciate in value over the life of the investment. And once you hit the age of 60 years old, or if the account's been held for at least 5 years past the age of 60, you are able to draw down from it tax-free, including the earnings that you receive on it, as long as you meet these 5-year rules and are waiting until you're a certain age, which it sounds like a great benefit, right? I mean, you're getting all this appreciated benefit now, and you're not having to pay the tax on it at a future date. The thing that I always like to keep in mind when I'm talking with my family, my friends, or with my clients about this is that what you have to think about is your current tax structure and what your future tax structure will be. Because the benefit of a Roth really reveals itself if you are going to be in a higher tax bracket when you retire compared to your current tax bracket as you're contributing into the plan. Because otherwise, I can just do a traditional IRA, get the immediate tax benefit or the basis associated with it now. And then when I pull it out at a future year, well, my tax rate isn't going to be 24%, it's going to be 12%. So in that case, a Roth IRA wouldn't make sense because all I did was front load all the tax burden at a higher clip than I would have at a lower rate when I was in my retirement age. So that's the first question I always ask to anyone asking about contributions to a Roth or conversions into a Roth of existing traditional accounts is, do you expect to earn more right now, or do you expect to earn more in retirement? Because that can end that conversation pretty quick. The other thing to think about from a IRA perspective is there's actually phase outs for Roth IRAs based on what you see on line 2 here, which is if you have modified adjusted gross income for your household over certain thresholds noted here, you're actually not even allowed to directly contribute to a Roth IRA account just based on the rules. So what has happened is you can do what we call a backdoor Roth conversion, where you fully fund a traditional IRA. And then on that day, essentially, the advisor will take that and convert it from a traditional IRA into a Roth IRA. This is a way to circumvent these phase-out rules, and it is one that commonly takes place. I mean, I do it for my personal funds, as well as my clients do it quite often. The thing to keep in mind with that is that it requires a tax reporting, so the IRS can track what you've converted from a traditional to a Roth. And in addition to that, if you have any source of traditional retirement accounts at the time of your converting of this payment essentially to a Roth, there's essentially some sort of pro rata rule where you actually have a tax effect by making that conversion and basically having to recognize some taxable income to some extent when you make that conversion. So it may have an unintended tax consequence if you're like, hey, this sounds great, let me do it. Well, think through what other sources of retirement earnings you have and what the characterization of it is, because you may have an additional, $2,000 to $4,000 taxable income hit as a result of your unintended consequence of doing a Roth conversion. Also want to take a second just to think about Roth conversions from a overall perspective when it comes to having portfolios that have appreciated $1 to $2 million at retirement. You can take those as well and make a Roth conversion if you think that that's a good use of your funds, because when you pull out at retirement, you don't even want to think about taxes. Key thing to think about is what I mentioned already, which is, do you think your tax rates are going to be higher now or later? But also, if you make a conversion from a traditional to a Roth account, there's a 5-year cool off before you can even touch those funds without it being subject to income recognition. So it may sound ideal to be like, all right, well, yes, this actually makes sense for me, but do you need an immediate use of those funds or access to those funds? If that's the case, maybe a conversion doesn't necessarily make sense to you. We're going to move on to the next slide, which is talking about the very heated topics of gifts and estate planning. We're going to go high level on just what you can do from a gifting perspective, just from a non-taxable standpoint, as well as what to think about going into year-end advisor planning with potentially an attorney about utilizing some of your lifetime exemption. As I'm sure Cas mentioned earlier, the estate taxes is a very topical item, because right now each individual is allowed up to 14 million of a lifetime exclusion in their estate. But if nothing changes in terms of tax law, that's going to be cut in half essentially to 7 million per person starting on 1/1/2026. So 2025 is kind of an important year to go ahead and start contacting estate attorneys now if you haven't, because we're going to need to get on their list to do any estate planning as soon as possible, since their schedule is rapidly filling up. But thinking through gifts as a whole, You are allowed to give up to $19,000 for any reason to any individual, completely tax-free. The recipient of a gift is always tax-free in this case, whereas you, the giftor, if you give over $19,000 to a certain individual, you may have a tax consequence by utilizing your lifetime tax credit or utilizing an exemption that you have associated with your account. There are 3 types of gifts that are non-taxable in general. If you have a U.S. citizen who is a spouse, any gifts to them is completely non-taxable. If you are making medical payments on behalf of somebody and you make those payments directly to the medical institution, that is a non-taxable gift and not required to be tracked for your personal gifting. And then finally, schools and tuition. If you make a tuition payment to your university, but you actually make it directly to the university, not to the recipient, that is also a completely non-taxable gift. Very common questions I get on that front. The other one I want to consider, especially as a result of the Secure Act that Cas mentioned earlier, is a 529 plan. In general, if you have a 529 plan, that is basically a college savings fund through various different state programs, right? So for Georgia, you're able to contribute and deduct up to $4,000 per dependent you contribute towards for tax purposes. And what essentially happens is it's put into a state investment fund where it can appreciate at a tax-free rate. And if you use those funds for qualified education expenses, that is something that is completely tax-free upon distribution to the individual for their books, for their tuition, etc., anything that's qualified. Well, what you can do is, because it's a growth investment account, is you can actually front load a lot of this through gifting, where you could contribute up to 5 years worth of your annual exclusion per person into an account. So if me and my wife wanted to contribute to our future kids' retirement account, we could potentially give up to $190,000 in 2025 into that 529 plan, completely tax-free. Now, the key there is that you can only do that once, and you can only do up to 5 years worth. If in a future year you give anything into that 529 plan between you and your spouse, that is a taxable gift that you'd have to report. But the benefit here is, obviously you are putting in the most amount of money at the earliest time so that you can get a derived benefit and the appreciation of that account that could potentially double or triple in value because you front loaded it. The other key to the 529 plan is, what happens if your kid gets a full ride and, hey, they also have this 529 plan that they didn't actually utilize? Well, you can give it to them, and if they pull from it to use for like a home payment, they'll pay some tax on it because it's not used for a qualified means. Or what you can do is you can have that whole account converted into a Roth account for them. The key with this is that the 529 plan has to have been in existence for about 15 years in order to qualify for that treatment. But that is a new topic that was brought about by the Secure Act that was not necessarily available before 2022. So that's a relatively new thing, where if you have unused funds in that 529 plan, it may make sense to just go ahead and get a jump start on their retirement planning and go ahead and set that aside so that when they get to retirement age, it's now had effectively time since they were, in their early age to appreciate up until retirement and be drawn from tax-free. Now, I mentioned estate planning. I want to pass it over to Cas here to kind of wrap up on trust planning, as well as just kind of give us something to think about as we end our time here in the next 5 minutes.
Great, thanks, Andrew. Yes, as the timeline shortening for being able to take action to use the inflated exemption right now, under the framework that the sunsetting for 2025 is going to impact this lifetime exclusion. So working under that framework, clients need to think about, if they're over that limit, or would be over the 7 million once it sunsets, what can they do now to try to move some of that wealth out of their estate? And so some common strategies that we've been seeing used a whole lot more in the recent years, we listed below. So just wanted to touch on these. You've probably heard of these, but just kind of things to think about as you're thinking about these with your clients. With a lot of clients, we're seeing them look at the spousal lifetime access trust, the SLATs. These all have really fun names, so little acronyms with them. But the SLATs can be used, they're an irrevocable trust. So something for clients to keep in mind is a spouse is putting, grantor is putting assets into a trust. So they are legally giving up access to those assets, with the idea being that their spouse is going to be trustee, is going to be beneficiary, can give them access to those assets. But keep in mind, when you're thinking about this and clients are thinking it through, that divorce or death of the spouse, these could be things that then limit and eliminate their access to those assets. Thinking about if the spouse was to die, now the kids own the assets. So is that kind of where you want that to be? So really thinking through that. With any trust, we always like to remind clients to really think about what other assets they have too. Do they have enough to live on outside of these trusts? Or how does that impact their lifestyle? Our second one we listed here was intentionally defective grantor trust, funnily known as IDGETs. So they're also irrevocable trusts. So taxpayers taking assets, moving it out of their estate and out of their estate permanently, but are not moving it out of their income tax grouping. So they will still be taxed on the asset inside the grantor trust. And so it'll continue to grow without paying taxes. So in essence, your grantors continue to kind of add a gift with those tax payments each year. Once again, really thinking about, okay, what am I putting into this trust? I've seen individuals put in stock of privately owned companies, and even though the beneficiaries were getting the cash distributions, the grantor was paying the tax on it. And so at some point decided we'll turn off the grantor status. So you can definitely look at these trusts and make sure you have some flexibility in the future. But it's always good to think of these things on the front end as well. But a good way to move assets out of the estate to take use of that lifetime exemption while it's higher. And then qualified personal residence trusts, obviously in the name, with a QPERT, this is to hold a house. So if you have a client that has a home that's going to be appreciating, think about oceanfront property, or the principal residence is expected to increase significantly. This can remove that personal home from their estate. But you have to keep in mind the timeline, because if the grantor dies within the term, then it would be pulled back into the estate. And I just realized we're very close on time. So we will run, this was our last piece. So let's just run, if you don't mind, Kathy, to our last page. I think it has our emails. And we are more than happy to forward slides or answer questions on this as well.
Thanks, Cas, and not trying to rush your
Nope.
editing here. So
Great, thanks so much. But yes, so there's lots of things that can be looked at, you know, both from an estate and asset planning, as well as income tax for the current year. So hopefully this has given you some ideas to think about for your clients and for yourself. And Andrew and I are here. Our emails are listed. Please feel free to reach out if you'd like a copy of the slides. I know somebody had requested that in the chat. Or if there's any questions we can answer for you, we're more than happy to.
thank you, Cas. And I'm going to turn it over to Liz Cashel, our president, to close us out today.
Thank you, Cas. Thank you, Andrew. And thank you all of you for joining us today for the EPI of Georgia's first quarterly meeting of 2025. As the new president of our chapter, I'm really inspired by the engagement and enthusiasm that you all show. And I'm just hopeful to re-energize our chapter and foster more meaningful growth this year. I also want to thank you for your flexibility in attending this virtually. We know it was very last minute. but we appreciate your adaptability, even when this weather gives us 3 inches of snow today. We hope you found this session on tax planning valuable and insightful. Please stay safe, enjoy the snow, and join us again for our February 5th webinar here shortly. Thank you, and we look forward to seeing you in our future events. Have a great day.
Thank you, guys.
Thank you. Thanks again. Bye-bye.